In the last lesson, we talked about how to individually analyze companies to invest in. That was the active way to invest in stocks. In this lesson, we're going to be talking about how to passively invest your money into stocks, meaning creating a system that way now your investments are automated, where you can just invest your money into the economy, into the stock market. And you don't have to worry about trying to find the perfect company. You don't have to worry about trying to find the best company because now, well, what happens if you invest in the wrong company? You lose all of your money. And this is where now, if you invest your money into funds, you can invest your money into baskets of stocks. So now instead of trying to invest your money into just one company, you can invest your money into a fund that's giving exposure to 50 companies or 500 companies or 2,000 companies. That way now, well, you're just investing your money into a broader basket. So if one company in your fund goes bankrupt, well, that's okay. It's balanced up by some of the winners. If one of the companies in your fund makes a lot of money, well, that's also going to be balanced up by some of the losers. So you have less risk, but also less upside, but it can also be completely passive and automated here. Because the way that you win in this passive investing system is you have to keep investing your money regularly. For me, it's every week. I do Wednesday just because it's in the middle of the week. It doesn't matter when you pick, but either every week, every 2 weeks, or every month, you want to keep passively and automatically investing your money into these funds because you want it to be automated, you want it to be passive, and you want it to be consistent. So how do you go about actually doing this? Well, let's start by talking about the different types of funds that there are, because there are 3 general categories of funds. You have index funds, you have ETFs, and then you have mutual funds. Index funds are known as your passively managed funds, which means that these are generally managed by a computer. And the reason why that's important is because now your fees are also generally less with something like an index fund. You can compare that to something like a mutual fund, which is generally actively managed, which means there's generally a money manager who's actively trying to buy and sell stocks within this mutual fund. Now, the goal is, well, when you have this person trying to find the best companies to invest in at the best times, the goal is to get better returns. However, the cost is you have higher fees. So the question is, are the higher fees going to justify the higher returns? And that's the question that you're going to have to make when you're now trying to figure out where you invest. Are the higher fees worth it or not? And then you have ETFs in the middle. ETFs stand for exchange traded funds. And ETFs are kind of a hybrid because ETFs can either be passively managed or actively managed, meaning they can be managed by a computer or they can be managed by a person. But the difference between ETFs and other funds is the way that they're traded. Index funds and mutual funds can generally only be traded once a day, meaning you can only buy or sell your index fund or mutual funds once in the day. With an ETF, they trade like regular stocks. So you can buy and sell out of your ETF really as many times as you want in a day. But again, that's not how you win in the system. You're investing for the long term, but ETFs give you that option. And the second difference is the minimums required to invest. Because generally, most index funds and most mutual funds will have some sort of minimum amount of money, whether it's $500 or $3,000 or $5,000 that you'll need to invest to own this index fund or this mutual fund. With an ETF, there's generally no minimums. So you can start investing with as little as $100, sometimes even less, if you want to go out and invest into this ETF. So you have index funds, ETFs, and mutual funds as the 3 general categories of funds when you're investing your money. But then you have to actually know how to analyze the fund that you're investing in. There are 3 questions that you want to ask when you're trying to analyze these funds. Number 1, the question is who created the fund? Number 2 is what's inside of the fund. And number 3 is how much is this fund costing me? So let's start by talking about who created the fund. And the reason why this is important is because there are some big, very reputable money managers out there, like on Wall Street in New York, that have created funds that are very recognized. You can compare that to a couple of guys in the garage who are trying to create their new fund that they want to get people to invest in. The reason why it's important to know who created the fund is because if something were to go wrong in the economy, if we went through a recession or a market crash, can this money management institution, whether it's a big bank or a hedge fund or this big institution or a couple of guys in the garage, can they withstand the loss of capital? Can they withstand the downturn in the economy, or is your fund going to go away because your money is in this fund and you want to make sure that this fund is going to be able to withstand downturns in the economy and the markets? So if the fund is better, well known, if it's more reputable, if they've been around a long time, and if they have a lot of dollars in there, well, that gives you some more protection. Of course, nothing is guaranteed, but you get some more protection if it's a more well-known and reputable fund. For example, Vanguard, Charles Schwab. These are just a couple examples of the behemoths of fund managers and fund creators out there. The second question you want to ask is, what's actually inside this fund? Because there's a lot of different index funds. Just like that, there's a lot of different ETFs. There's a lot of different mutual funds. And to answer this question, the acronym that I like to follow is CDAA, which stands for Companies, Dollars, and Asset Allocation. So the first thing that I like to look at is, well, which companies do I want to invest in? Like, there are funds that will give you exposure to the total stock market. There are funds that will give you exposure to the S&P 500, which is a group of the 500 largest companies in the stock market. There are funds that will give you exposure to healthcare stocks. There are funds that will give you exposure to AI stocks. There are funds that will give you exposure to tech stocks. There are funds that will give you exposure to international stocks. So the question is, what do you want to invest in? And that's the first part of what you're investing in. What types of companies do you want to invest in? The second thing you want to take a look at is dollars. And by dollars, I mean, how much money is actually in this fund? And this is an important number to take a look at because, well, if things were to go wrong and there's not many dollars in this fund, it can be very hard for you to exit or sell or get out because nobody wants to buy this fund. So the general rule of thumb that I personally like to follow is when I go out and I invest in something like an ETF, I generally like to look for a minimum of $1 billion in assets under management, because if there's $1 billion in assets under management, I know that this fund is very liquid, meaning there's always people buying and selling this fund, and selling this fund should not be an issue, generally. Now, if I wanted to invest in something that's a little bit more smaller, something that's a little bit more maybe obscure, I do have some exceptions to this rule, which is where the very bare minimum that I like to look for in terms of assets under management is 100 million. Because if a fund has under $100 million in assets under management, to me, that's too risky. Now, for others, maybe it's not, but for me, that's too risky, because if it has under $100 million in assets under management, then to me, that means if something were to go wrong, there's not enough volume being traded. There's not enough volume of this fund being bought and sold. So if I wanted to sell this fund when things were wrong, I could be stuck holding onto a fund that I can't get out of. And to me, I don't want to take on all that risk, which is why generally I look for $1 billion in assets under management or more, but I will come down to $100 million if the fund is right. And the third thing that I like to take a look at is the asset allocation. And what that means is there are multiple funds that will give you exposure to the same thing. But there are multiple funds, ETFs, that will give you exposure to artificial intelligence stocks. There are multiple funds that will give you exposure to tech stocks. There are multiple funds that will give you exposure to healthcare stocks. But the question is, which one is right for you? And this is where now, inside of the fund, you can take a look at, well, which companies is this fund investing in versus this fund? And how are the funds distributed within these companies? And what you'll see is some funds will invest in the same companies, but they'll allocate more dollars to certain companies over other companies. The third thing that I like to take a look at is, how much is this fund going to cost me? This is called the expense ratio. When you go out and you invest in any fund, there are fees, because whether you're investing into a fund that's passively managed by a computer or actively managed by a money manager, somebody's got to get paid, and you're going to be the one paying those fees. And so this is where you want to take a look at the expense ratio. Now, the important thing to understand about this expense ratio is that this is a fee that you pay every year on all of your assets. So if you have $100 in a fund and the expense ratio is $1, that means this fund is going to take $1 in fees just for you investing in this fund. And this is going to happen year after year after year for every year that you own this fund. And every time you invest more money into this fund, well, there's more fees that you're going to have to pay. And as the fund grows, there's also more fees, which is why you want to make sure that the fees are justified. If you're investing your money into a fund that has very high fees, well, you want to make sure that these fees are justified, meaning the potential return is higher, and to justify that. And to kind of put into perspective the cost of these fees, if you invested your money into a fund that has a 1% expense ratio, do you know how much this fee will cost you over the lifetime of your career, assuming you start investing your money into this fund around the age of 21 and you continue to invest your money into this fund until you retire. How much is a small 1% fee going to cost you? Well, it's going to cost you a little bit more than 25% of your entire investment portfolio, which means if your investment portfolio would have grown to $1 million, just over $250,000 are going to go to fees because of the small little 1% fee. And the reason why is because the 1% fee isn't just on the assets that you put in, but it's also the compounding growth of that fee. Because every time you make more money in this fund, well, that fee is also going to grow. Not because the 1% fee is always rising, but because the amount of dollars that are being taken in fees are also rising, which is why if you're going to be paying higher fees, that's okay. Just make sure you understand the cost of the higher fees. Are the higher fees justified? Is the potential return high enough to justify the higher fees? These are the types of questions that you want to be asking. And let's go through an example. Let's actually read through the numbers of VTI, which is an ETF that gives you exposure to the total stock market. All right, over here, I pulled up the Vanguard website and I have the VTI ETF. I know this is Vanguard because if you do a quick Google search and you find the total stock market ETF, well, it tells us Vanguard. And here we are on the Vanguard website, which has VTI here. And it says the Vanguard total stock market ETF. So the first question is, who created this fund? We know it's Vanguard, and Vanguard is one of the most well-known institutions out there that create things like index funds and ETFs. So Vanguard is a total stock market ETF, which brings us to the second question, which is what's in the fund? CDAA. And if we start with which companies is this fund investing in, we know this is the total stock market ETF, meaning this is giving us exposure to the broad stock market. The second question is D. How many dollars are in this fund, which means what is the total assets under management? And what we'll see here is that the total assets under management at the time of me recording this video is $1.4 trillion, which is clearly past the $100 million base level that I like to use, and it's even higher than the $1 billion general level that I like to look at. And the third thing that I like to take a look at is the asset allocation, which is now which companies is this fund investing in. And the first thing we see here is the weighted exposures, and you'll see the different sectors that this fund is investing in, from utilities to basic materials. Now, if we go a little bit lower, now you can see which companies this fund is investing in and what percentage of this fund is comprised of this company. So you can see how much money is going into each individual company. And every fund that you want to invest in, whether it's an index fund, mutual fund, or ETF, will have a page like this that you can research with a quick Google search. That way you can see, well, what type of research do you want to do? And is this fund a good investment for you? And then the last thing I want to take a look at is the cost. This is the third question that I like to ask, which is how much is this fund costing me? Which means what is the expense ratio? And what you'll see here is that the expense ratio is 0.03%, which means if I invested $100 into this fund, my fee on this $100 will be 3 pennies over the course over a year. So if you're not interested in doing all the upkeep and analysis and research of individual companies, that's okay. You can invest in funds which will give you exposure to the stock market, and there are funds that will give you exposure to pretty much anything that you can imagine. But if you want to succeed as a passive investor, you want to make sure that you have a system where every week, every 2 weeks, or every month, your money is automatically and passively being invested, whether the market is up or the market is down, which means, yes, even if you see a market crash, you don't want to stop buying, you want to keep buying. In fact, that might be the time to even potentially buy even more. But in order to do that, you want to know, do you want to be investing in index funds, ETFs, or mutual funds? And then you want to go a little bit deeper and ask yourself the 3 questions. Number 1, who created the fund that you want to invest in? Are they reputable? Number 2, what's inside the fund that you're investing in? And to answer this, you want to ask CDAA. What are the companies that you're investing in? How many dollars are in this fund? And what's the asset allocation look like inside of this fund? And the third thing that you have to ask is, how much is this fund costing you? What's the expense ratio? Because you want to make sure you're not giving away all of your profit in fees. What I'd like you to do now after this lesson is to go out and think about, now, do you want to be more of a passive investor or do you want to be more of an active investor? And if you want to be more of a passive investor, that's okay. I want you to go out and start researching at least 2 index funds, 2 ETFs, and 2 mutual funds. Go out and find them in whatever sector, whatever industry that you are interested in. And then I want you to go through the 3 questions. Number 1, take a look at who created these funds. Number 2, take a look at what's inside the funds. CDAA, what are the companies? What are the dollars? What's the asset allocation? And the third thing that I want you to do is take a look at the fees. What is the cost of this? Again, if you are overwhelmed, use the workbook as a resource to help guide you through these steps and share what you're doing in the community as well. That way you can hold yourself accountable and keep moving towards your investment goals.